Good morning, everybody. Thanks for joining us for the second in a series of webcasts on market forecasting in an age of transition. And we really are in a state of transition. Our climate, our generation fleet, our capital markets, and our energy trading strategies. Today, our time frame is long-term. We're going to be talking long-term forecasting, not just about getting through the summer. Let's set the stage. In our first session on May 25th, we focused on critical issues and structural drivers. How to develop market forecasts that account for emerging market dynamics associated with high renewable penetration while remaining firmly grounded in long-term economic equilibrium. Today, we'll shift the focus a bit and take a look at Ascend's market outlooks, including our analytical insights into key drivers for spot prices, volatility, and ancillary services and capacity prices for all major ISOs. Our outlook accounts for evolving supply and demand conditions and changing market fundamentals driven by high penetration of renewables and batteries. As might be expected, we're seeing increased volatility, changing price shapes, and real-time price spike patterns. As we get started, let's advance one slide and take a look at a few housekeeping items. This is an interactive session. Please send me your questions in the chat window at the bottom of the page, and then we'll take them on at regular intervals. And then we're going to be running two polls. We encourage you to participate in those. So Ascend Analytics is delighted that you're here. We're looking forward to helping you make the most of this rapid innovation in energy production, distribution, and trading. And now I'm delighted to introduce Dr. Gary Doris, our founder, CEO, and internationally recognized thought leader, to get us started.
Good morning. It's great to see summer roaring through Colorado today. We're going to be in the mid-90s. And that's where all of us are speaking from today. It's exciting times, certainly in the power industry. And Brent's going to be explaining Ascend's current market outlook in the lens that we take to determine the future. Certainly, we've done a lot to overcome model limited choice and some of the limitations of traditional modeling to develop our market outlook. And I hope you enjoy this new view. I think it captures the new market dynamics, provides the right intelligence in terms of views of not just where prices are going, but the variability in prices and how those interact in this transition to higher renewables. Just a little bit of background on Ascend. I know we have a lot of attendees from last event, so I'll continue to go through it at a good clip. We're pretty well known in the industry, particularly around renewables and storage and this integration, as well as portfolio management, hedging around assets for either utilities or merchant exposure, as well as long-term valuation, be it for independent power developers or utilities. And the key component that we'll be talking today about at the bottom of this slide on the right-hand side is Ascend's market intelligence, our reports and forecasts and interactive websites to look at forecasts on a nodal basis now, real time, for most nodes now in the country or soon to be are being published. And this is a real feat computationally. And not only do we have 60 employees, but we have something like 4,500 computing cores working at Ascend to help produce these market forecasts. In terms of our role in the industry, we're doing significant amount of work on the utility side as well as on the developer side, helping provide independent market assessments and valuations for both buyers and sellers and supporting independent evaluations for financing. We've done about 30 financings in terms of independent market assessments over the last 12 months. All right, with that, I'm going to turn this over to Brent, and he'll bring us up. If you wouldn't mind going back to the highlights from last workshop. I'll turn this over to Brent, and he'll take us through what we're seeing today as we look forward through time. It's different than looking through the rearview mirror. he's building on what we discussed last time, but if you didn't attend last webinar, it's okay. I think there's a lot to extract here. The highlights of last webinar were understanding how the supply mix was changing, and these fundamentals impacted new market conditions and price dynamics. The bottom line, I think that Brent covered last time, is there's a lot more variability in price as we have more renewables because of the intermittency inherent with weather as the new fuel. We discussed some of the methodology in long-run equilibrium and the idea that competitive market dynamics have to, in the long run, adhere to equilibrium conditions. And that just means, quote unquote, normal returns, and there's no excess cash on the table. One of the key components as we undergo the structural change was the geospatial considerations for long-term resource valuation. How do supply dynamics change? How do we end up with more congestion in some areas and less in others? And what are these bottlenecks going to result in terms of basis differentials and variability in price? And how does this impact valuation? Ascend's forecast is looking at taking this kind of newer lens, we call it a high definition production cost model, and bringing it into the future at this 5-minute granularity. And with this lens, we're uncovering a lot of, say, nuances that create value, typically around flexibility, and frankly, diminish value for resources that don't have flexibility or are producing during periods where power will be worth extremely less. If we go to the next slide. And to take us through this is going to be Brent Nelson. He's our manager of forecasting and market analytics. Brent has a PhD from Georgia Tech and did his undergrad at Cal. He leads the forecasting practice at Ascend, and we've done an enormous amount of work in, I think, paving a way for new resources, particularly storage and combined hybrid projects, to be understood by the financial community in light of the new market dynamics. And he's certainly been a thought leader at Ascend in doing this. Prior to joining Ascend, he was a full professor at of mechanical engineering at Northern Arizona University. And he also worked with the U.S. Department of Energy on a number of projects focusing on energy efficiency, demand side management, and market dynamics. With this, Brent.
All right, thanks, Gary. Let's dive into it. So I'd like to start off with a poll. Maybe Carlos, if you can pull the poll question up. Which markets are of the greatest interest to you? As we look across the US, CAISO, ERCOT, New York, New England, SPP, PJM, MISO, maybe something else. It would help us just to get an idea of where our audience's biggest interests are. So maybe we'll give a few seconds for people to respond here, and we'll see what the results come out. All right, looking at the results, top two are CAISO and ERCOT being the biggest, followed by PJM. All right, that'll help us kind of tailor today's presentation to focus on those markets. All right, so agenda for today. I want to emphasize that today is just a taste, right? So we have full market reports for each ISO that go into much greater depth than we're able to cover today. But we'll kind of touch on some of the highlights for each of the markets, CAISO and ERCOT, because they have kind of the most transition that is currently in process or has already undergone. Those are the ones that we'll have the most content on, but we'll touch on all the ISOs today. So we'll look at renewable outlook, thermal retirements, outlook for storage, price dynamics, price volatility, and some geospatial considerations. So before going into each ISO specifically, I want to start with a handful of national level trends that rather than say the exact same thing for every different market, these are pretty much truisms across markets. So the first truism is that renewable economics are a driving force. When we look at the prices for renewables, they're in the 20s and the 30s. If you look at solar and PJM, you don't typically think of that as a great solar resource, but you're still looking in the low 30s, mid 30s. Wind, 20s, teens, 30s. These price points are really getting into variable price territory. And so, the old argument against renewables was that, well, renewables aren't reliable, so you're still going to need thermal capacity. So you're going to need to build both thermal and renewables if you want renewables, and it gets really expensive. But when renewables start to hit the variable costs, it becomes cheaper to build both and use the renewables and not run your thermal than to build your thermal and run your thermal. And so we see this as an increasing trend. So when we're talking about kind of renewables versus existing thermal, renewables are moving into competitive territory. When you look at renewables versus new thermal, they don't really even compare at all. So we see lots of batteries coming in, solar plus storage, solar and wind being almost everything we see in the interconnection queue is pretty much across markets. So that we see kind of everywhere in the country. To kind of dive into a little bit more detail about some of these economics, let's look at kind of an existing coal resource, right? So these are rough numbers, not meant to be exact, but if you have a variable operations cost of around $2.50 a megawatt hour, fuel, coal price at $2.50 an MMBTU, give or take, heat rate of around 10, and a fixed O&M cost of about $3 per kilowatt month. If you run that coal plant a lot, say 80% capacity factor, that comes out to an all-in annual operating cost of about $40 a megawatt hour. Notice that is higher than most of the wind and solar PPAs that I just showed, right? So even at a high capacity factor, your all-in effective energy cost is getting to be a territory where it's higher than the renewables. When that capacity factor goes down, it gets worse, right? So that fixed O&M cost gets distributed over fewer and fewer megawatt hours, and your effective cost just goes up and up and up. And so that really puts a lot of pressure on kind of the economics of the operation of even existing coal resources. If we look at new resources and we compare kind of a new natural gas combined cycle to a new renewable, now we're going to throw the CapEx in there as well, because we're going to assume that it's not fully depreciated. And at an 80% capacity factor, you're around $40 a megawatt hour. Again, a little bit more than most renewables, even in the less ideal renewable locations. When you get into lower capacity factors, again, it gets worse. So this is why we see renewables being pretty much everything in the interconnection queues. Another trend that's kind of true across the board is thermal retirements and really starting to distinguish between energy and capacity. If renewables are your cheap source of energy, but they're unreliable from a capacity standpoint, then what you really want is your cheap energy coming from the renewables and flexible, reliable capacity that kind of operates around it. But if that's true, then what you want in that flexible, reliable capacity is a high flexibility and a low fixed cost. Because if it's not going to operate very often, you don't want a high fixed cost to distribute over a small number of megawatt hours. And so the old paradigm was, you had your base load, which ran all the time. You had some ramping stuff to handle your daily cycling loads, and then your peaking to handle your, seasonal peaks. So that was kind of the old mix. But as we move into this age of low cost renewables, what we're going to see increasingly is intermittent energy sources, which have a low total cost of energy, zero variable cost, but are unreliable from a capacity standpoint. And then you want flexible resources to fit around that. And those flexible resources should be quick start, quick stop, fast ramp, low fixed cost with reliable capacity. And if that's kind of the model that we have for this kind of low cost renewable future, we have to rethink the definition of what a stranded asset is. Historically, you would say, here's a plant that doesn't operate very often. It's a waste. It's a stranded asset. But in an era of cheap renewable energy, what you want is thermal resources that are reliable, provide fixed capacity, but operate at low capacity factors. And that's not necessarily stranded. That's still providing a critical reliability to the system. And it's okay if it operates at a declining capacity factor, because that means it's still providing its role of providing reliability to the system. And so we need to really rethink the roles and the functions that different parts of the system play when we have an intermittent energy source, as compared to kind of the old paradigm where the same resources could provide both energy and capacity. Another trend nationwide is increasing policy mandates. When we look at renewable and clean energy targets, they are continuing to spread across the country, continuing to become more and more aggressive. More and more states adopting 100% clean mandates. Even a variety of kind of old traditional thermal utilities have defined decarbonization goals, 2040, 2050. If we look at states with kind of legislated 100% clean standards, there's, California, Washington, New Mexico, Virginia, New York, DC, Hawaii, Puerto Rico. So, 8 there. There's another big group with 100% goals, goals for 100% clean energy in some form or another. Then there's a handful of states that are maybe likely to follow. And, between these 3 categories, you get to over half the country. So the question is, are there more states that are likely to move this direction in future years, particularly as the economics of renewables continue to get cheaper and cheaper, as storage gets cheaper and cheaper. And so the integration becomes a little bit more manageable as well. So it's kind of dominoes all falling, or a snowball rolling downhill. We see more and more states moving to more and more aggressive targets. I touched on this in the last webinar. Another trend is corporate demand. So, it's not even what's economic. It's not even what's mandated from a policy standpoint. It's also, corporate ESG goals that are targeting increased, clean energy and energy offsets and things. And so that's driving a variety of additional project developments as well. So that has to be a critical part of the picture, is understanding, even beyond economics, even beyond policy, how many local companies are contracting with PPAs, how many large corporations are contracting with PPAs in order to get clean energy, how many states are incentivizing clean energy to attract those employers. And this map on the right, I think, really tells a pretty critical story, which is that, these are all wind and solar projects with a corporate PPA. And this is a lot of capacity. This is a lot of energy. So, we see all this stuff in Virginia, we see all this stuff in the Midwest and Texas, all throughout PJM, California, Utah. There's a lot of demand, and that demand is only growing. Even in COVID year 2020, we still saw it grow by almost a fifth. So there's a lot of demand there, and we see that continuing to grow. Another trend that we see across markets is as renewables come in, prices go down. This CAISO, ERCOT, SPP, these are the 3 markets that have pretty high renewable penetrations historically. And what you can see is that, if we look at price data, this is real-time price data on the bottom, day-ahead price data on the top. As renewable penetration goes up, those prices go down. And once you get up to about 50%, they're almost always 0 or negative. And we see that pretty much across markets. So understanding that price depression impact of renewable penetration is a story that we see kind of across the board. We see it in markets that have high penetrations, and we expect it to come in the markets that don't yet have high penetrations. At the same time as we see prices going down on average, we see volatility going up. Ascend has developed its own metric for real-time price volatility. We call it congestion persistence. And it's really kind of how often do extreme prices show up. So prices above 100 or below 0. This ends up being really useful, particularly for looking at the revenue potential for batteries, because you can generate revenue off of negative prices and you generate revenue off of selling. Typically, you're going to sell when prices are high enough to make it worth your while. You don't really care about price volatility when it's going from 20 to 30 or 20 to 40 because those deltas aren't big enough. It's kind of these higher prices that give you enough of an arbitrage to actually make it worthwhile. So anyway, this is a volatility metric that we use. And what we can see is across markets, CAISO, renewable penetration went up, volatility went up. ERCOT, same story. SPP, same story. A couple of exceptions, 2020, the COVID year, different load shapes, very low volatility. We saw this across the country. Variety of changes, I think particularly driven by the change in commercial load as more and more people work from home. In addition, 2019 in CAISO was also kind of a strange year. There was a really low net load. It was kind of down to 2013, 2012 levels. So that was a factor there. But in general, we see renewable penetration going up and volatility going up across the board. Another really important trend is understanding saturation of ancillary markets. Storage is pretty perfectly suited for providing ancillary services. If you look at providing spin, storage is basically always online. And so it doesn't really have any min-gen levels. It doesn't have any operating costs associated with being online. So it provides spin really well, ramps really fast. It's also really good at providing regulation. But the problem is that those markets aren't very deep. And so storage is ideally suited, but storage can fill up that market pretty quickly. So as those markets fill up, we expect ancillary prices to collapse, again, pretty much across the board. And the way to think about this is, if there's no price volatility in a given hour, storage isn't going to be providing arbitrage because there's no price volatility. And so it might as well earn something because something is better than nothing. So anything above zero is going to be advantageous to storage. And so if you have lots of storage sitting around doing nothing, if you say have 500 megawatts of storage in a market that only needs 200 megawatts of frequency regulation, that regulation market is going to fill up pretty quickly. And so we expect those prices to collapse pretty much across the board. So a lot of backcasts for storage are looking at these pretty high values for ancillaries, but we definitely do not see that moving forward. This graph here shows just kind of example for ERCOT. The primary market for ancillaries in ERCOT is the RRS, which is basically spin. So the green line is our forecast for kind of what our expected growth is for the spin market, and the gray is the amount of storage on the system. And within a few years, there's far more storage than you need for that spin. There's also load resources in ERCOT. That only makes the effective opportunity even smaller. So these markets fill up fast. And if we look at the pace of storage in most markets, it's much, much larger. That the outlook for storage build out is much, much larger than the size of these ancillary markets. And so that saturation is going to come quick. Finally, one more trend to hit on is the nature of the critical conditions for the system and the way that they're changing. Historically, we often think of most markets having their peak demand in mid-afternoon when it's at its hottest, right? But that may not be the critical event anymore. In CAISO, there's so much solar on the system that when they're most likely to have shortages isn't mid-afternoon, it's right around sunset as all their solar is rolling offline. With the amount of solar coming into ERCOT, we expect a similar story. The shortage is going to be when load is still high, but the sun isn't generating anymore. And as we look to electrification scenarios where heating loads may be getting electrified, transportation is getting electrified, people are charging overnight, very likely to move into an era where overnight winter peaks may be the critical conditions that the system needs to plan around. So when we think about capacity values, when we think about scarcity revenues in ERCOT, we have to think about what those critical conditions are when the grid is going to be the tightest, because those conditions may not be what they have been historically. And so, we need to be aware of and planning for what those time periods are going to be. If you're a solar resource in ERCOT planning on getting a lot of scarcity revenues, you're probably going to be disappointed as we move forward. if you're in New England and you're a solar resource planning on, getting capacity auction credit, that may not be a source for you if the critical condition on the system is going to be winter peaks. So we have to really pay attention to when the system is likely to be oversupplied, when it's likely to be undersupplied, and how that's going to evolve moving forward. Same consideration as well, by the way, for storage. If the period of concern is a 2-hour period during sunset, that's very, very different than if the period of concern is a 1-week storm where you don't have sun and wind for a week, because the duration of capacity that you need could be very different for those two scenarios. And so we have to understand what's the evolution of the capacity value of resources for the system. So some things to think about on the ESG standpoint. What percentage of companies do you think are going to be procuring 100% clean energy by 2030? Going beyond that, what percentage are going to be trying to do 24/7 clean? How much renewable procurement is that going to drive even beyond what's economic, even beyond what's mandated from a policy standpoint? What percentage of utilities do you think are going to have near-term targets for clean energy? Right now, most of them do. I would expect that by 2030, it'll probably be almost all of them. And so what are the implications for renewable penetrations, given that supposition? If we look at the policy trajectory, given the economics of renewables, how are regulatory commissions going to view new gas generation? We've already seen a variety of even red states that have rejected IRPs with gas generation in them because they want to see more non-wires alternatives. They want to see more demand response. They want to see more storage. And so, what's the regulatory view on thermal resources? We also have to think about what the future accredited capacity is going to be for renewables and storage. As I said on the last slide, we have to think about what the critical conditions are for the system. And so if you are, a solar resource in a market that's currently getting 60, 70% capacity value, how long do you expect that to be true? And how long before you expect that to change? Do you think any states are going to loosen their clean energy targets? I would argue that will not happen. How many states are likely to tighten their clean energy targets? How many states are likely to adopt 100% clean? In the slide a few slides ago, I showed a list of 7 or 8 states that I think are reasonably likely to adopt a standard along those lines. And then we also have to consider what the chance is of a federal carbon or clean energy policy. That's a more difficult one to address. In our forecasts, we assume a federal carbon price that is something in between where it is likely to show up if it actually does come and zero. And that's kind of our attempt to mitigate the risk of 2 very different outcomes. But we have to think about that as we think about the future. So I want to pause real quick and just, as we move into talking about our market outlooks for each market, it'll help to kind of frame that with a slide that I've shown before. And if you've seen any presentations with me or with Ascend, you've probably seen this slide. But this is how we think about markets. I spend a lot more time talking to people about input assumptions than I do talking about the models themselves. And the reason for that is that even if you have a perfect model, which nobody does, if you have a perfect model of an incorrect future, then it's an irrelevant model. And so I spend a lot of time talking to people about what are the input assumptions, because the input assumptions really matter a lot. What's the input assumptions around system reliability, around load growth, around renewable build out, stakeholder demand. These all create critical conditions for the market outlook. And so as we show our market outlooks, I just want to emphasize that we are paying very close attention to the inputs. So what's our policy outlook? What's in the supply stack? How do we expect the supply stack to evolve? We're also paying attention to the critical drivers of price formation. So we are working hard to model how renewable generation and intermittency leads to curtailment. And this is a linkage that a lot of models miss, because when you perfectly optimize dispatch against perfectly known load and perfectly known generation, you miss the uncertainty that leads you to keep thermals online for the what if cases of what if the cloud comes, what if the wind gusts. And that need to keep thermal online is what leads to a lot of the curtailment, because the thermal side of the system has to stay online at min-gen levels, can't ramp fast enough. And so you have these ramps on the renewable side that lead to curtailment as well as price spikes when you have positive net load ramps. So we're working hard to model some of these emergent price dynamics that show up with a high renewable system that just didn't matter as much in a thermal dominated system. So we're really trying to capture some of these new market and price dynamics. And then we're providing outputs that are the ones that you really need to understand. Price shapes being a critical one. Average shapes don't matter if your generation profile has a shape to it. You have to understand how your generation profile aligns to price shapes, and that's critically important. We're also looking heavily at real-time prices because those are critical drivers, especially for storage. We're looking at price volatility. Price volatility matters a lot for flexible resources. If you're an inflexible resource, average price is the only thing that matters because you're on all the time anyway. But if you have the ability to ramp, to turn on and off, then understanding volatility makes a huge difference for kind of what your revenue potential is. As Gary mentioned, long-run equilibrium is one of our critical anchors. We don't leave cash on the table. So, a forecast that says that storage is going to earn 25% returns, we think is ludicrous, because if storage can earn 25% returns, we don't think that the whole world is too stupid to recognize that. And so resources will enter until things go back to normal. We do also look at barriers to entry, though. For example, right now, storage looks great in California, but there's 4 to 5 year project permitting and development pipeline. And so even though it's great now, it's going to take 5 years to come online if you see that now. And so we're looking at some of those timing barriers to entry. We're also looking at geographic barriers to entry that lead certain market dynamics to stay persistent in some regions and not in others. And I'll get into that more when we dive into the markets. So, kind of to summarize the key takeaways here for these national level trends, renewables are increasingly the lowest cost form of energy. But it's not just energy. We're still going to need capacity. But as we look at most interconnection queues, it's all renewables and storage, almost all renewables and storage. But economics aren't even the only driving force. We also have to think about policy, off-taker demand, stakeholder pressure. We believe that renewable build out in general is going to be much higher than that predicted by a strictly economic model, because a strictly economic model isn't going to take into consideration some of these policy trajectories and off-taker demand factors. We expect thermal capacity to see declining capacity factors even when it's still needed for reliability. So what that means is that we expect thermal capacity to kind of turn over, and the inflexible, high fixed cost thermal capacity is going to be forced to retire as those capacity factors decline. And to the extent that we see new thermal capacity, we expect it to be flexible. And that'll be the key resource for being able to accommodate increasing renewable penetrations. So with that, I want to do another poll question, and then we'll do some Q&A. So if Carlos, you can launch kind of the next poll. Of these kind of national level driving forces, we're curious to see which driving forces, as you think about these market outlooks, which ones do you think are kind of the most important factors to think about a long-term market view for each of these ISOs? So we'll give a few more seconds for people to respond. All right, so looking at the results, policy is number one, followed by renewable economics and thermal retirements. So corporate stakeholder demand, not huge. I think that's actually going to be a bigger issue than a lot of people realize. Price depression, volatility. All right, good to know. So policy, thermal retirements, and renewable economics being the big three. Those are certainly big three. All right, let's take a moment to pause, and we'll do a little bit of Q&A before we jump into specific questions.
Brent, I do think, just to round out the poll there, I think people are right. It's a mixture of things. Obviously, policy has historically had a lot of import in terms of this transition of renewables and setting the stage. But I think we're at the juncture where the overall economics are critical. So policy in terms of moving the renewables forward, and they clearly have won by most metrics. I think the area where policy becomes more decisive is in addressing the issue that's on the table with respect to assets that are, as you said, less flexible, perhaps out of the money, and how's that recovery going to work so we can expedite this transition. It's not really fair for utility to make an investment in the ratepayers' interests and then have a disallowance because technology evolved at a different rate than was expected when they made the decision. And the transition in policy is less about the requirements and the mandates and more about the recovery of stranded costs. So we do have some questions, and let's move on with them.
Yeah. Tom, if you can MC that.
So the first question is, how will you make money in the future if prices are depressed so far and the ancillaries markets are so saturated?
That's a good question. That's really where understanding the disconnect between average and volatility is so important. So if you have, well, it depends on the resource, first of all, but if you have a thermal asset, for example, that is forced to be on full time, you think about a nuclear or maybe a coal, volatility is not something that it can really track and follow that well. So this is where we really see value and flexibility. And so models that don't correctly account for or forecast volatility are missing one of the key pieces of the value stack for a flexible resource. Gary can talk about this as well, but there's this notion of model limited choice. And if your model doesn't account for the volatility properly, it's not going to value flexibility properly, even though the market signals are calling out for flexibility. So we see volatility being a really key driver, particularly for flexible resources, and those resources that can't track volatile prices, can't turn on, can't turn off, can't ramp up, can't ramp down. Those are the ones that are going to be the most severely impacted by price depression. And we're already seeing that kind of across markets.
Brent, obviously we're completely aligned on this. And the only comment I want to add to this is ancillary market prices are going to be under pressure. They're not going to fall off a cliff to zero, but up to the point that the opportunity cost of participating in energy equals ancillaries. And we are going to see, I think, with technology evolving and power becoming effectively digital with very limited moving parts, that digitization just means things are solid state. And we're going to continue to see declines in prices, a lot of average prices for energy under pressure. But there are going to be extreme shortages during certain periods. Scarcity conditions do exist. We are probably at an earlier stage of transition towards electrification of transportation and other sectors. And that's going to create a transition with more demand for power and probably conditions where shortages will be known, and the price signals in markets, if they work clear, will be very loud and pronounced, and resources will come on to meet those price signals. So why don't we go to the second question? What ISO is best for battery energy storage systems, economic justification, and what size BESS alone makes a good case in that ISO?
That's another good question. Where we see The first thing I'll say is that it very much, even within an ISO, it can vary quite a bit. Some areas much more congested than others, some areas much more volatile than others. While with broad strokes, we can say that CAISO and ERCOT are the best markets for storage right now. Even within CAISO and within ERCOT, different nodes have very, very different price dynamics. So some nodes are great and some nodes are not so great. But in general, CAISO and ERCOT are the most volatile. One of the challenges in CAISO is that it's very volatile right now, but when we look at the long-term outlook, by the time, if you saw that today, by the time that you've got a project online, a lot of that volatility is likely to have been dissipated by all the other storage projects in the pipeline. So that outlook is a little bit different than maybe in ERCOT, where you have a faster kind of permitting and online process. So then kind of the next question becomes, what are the markets that aren't there right now, but are looking a lot better within the next few years? And so that, where you have kind of some policy mandates and storage targets, that helps as well. So in New England and New York, there are some storage targets, and so that helps those environments. Then there's some markets that are extremely non-volatile. So MISO, very non-volatile. PJM, very non-volatile. Even ISO New England is pretty non-volatile outside of Boston. So those are a little bit tougher without having some kind of contracted opportunity. PJM is a little bit different though, because there's a lot of data centers that are looking for 24/7 clean energy, and so they are more willing to contract with storage, and so there's maybe some better off-taker potential. So there are a variety of different factors that can all play into it. In general, where we see the highest volatility is ERCOT and CAISO though.
Yeah, Brent, an SPP is certainly right in the mix maybe as well.
Yeah.
Different
So
type
I'll
of
talk about this when we get to SPP. You've got the volatility there, but a lot of the volatility is on the low side.
Yeah.
A lot of low prices, a lot of negative prices, and you don't get quite as many high prices, which is what you really need to drive revenue.
So the next question is about PV and the integration of PV with storage, and what makes the economic justification work. And this is something that we've seen as Ascend runs quite a few RFO, RFP processes for utilities and CCAs, munis. And in running these processes in 2020, we found that solar plus storage was more economic as a whole, and almost always picked in preference to storage, even in the best of locations, just because the ITC and let's say some of the better sites around solar and storage at this juncture. So generally the scale in 2020 was tilted towards solar plus storage. We don't anticipate that continuing on at that same degree, where it's almost all wins on that side, just because the basis differentials are growing and the variability of prices in urban cores are growing. We would expect there'd be some equilibrium, and you just can't have solar plus storage in the periphery without augmenting with storage typically in urban areas. So we have a question from Sam Golding about, speaking of CCA movement, Sam's one of the leaders of that, in retail demand flexibility. And he's asking, at what point is this going to become significant enough to start incorporating the models and having a pronounced effect on price formation?
Yeah, I think that's a great question. I worked at Department of Energy on a variety of kind of smart building and load flexibility projects. Have continued to work with Department of Energy on those. Worked at NREL with some load flexibility modeling. I'm pretty optimistic about it, particularly as you get more and more EVs on the grid. So having like big chunks of flexible load really help the business model from an aggregator standpoint. So having big chunks that you can kind of deploy in batch really helps the transaction costs and customer acquisition. A lot of what I've seen on the load flexibility front is the biggest challenges are on the business model. The old challenge in energy efficiency has always been measurement and verification, M&V. How do you, without a counterfactual, how do you prove what you saved, because you can't show what would have happened if you hadn't done a given action. And that's one of the ongoing challenges with load flexibility, participation in wholesale markets or capacity markets even. I've also seen some issues around transaction costs, customer acquisition costs. I think those are issues that will continue to work towards getting resolved, but they haven't gone away yet. But I think there's still a lot of potential there.
Brian, I would agree that there's a lot of potential. There remains something that if the market's going to work well, we're going to have true price signals that are really loud and clear. I think people will respond, and demand side will be perhaps a big part of the equation. Historically, it hasn't worked out that well, and it does require some evolution of technology, kind of using the Internet of Things more effectively. But that's now becoming a bit more of a reality. The flip side is on the supply side, the cost of flexible generation, particularly storage and short duration, is extremely competitive. And if the Internet of Things is going to work, yes, that customer acquisition costs really need to come down. And we need to take advantage of the aggregation at a really low cost.
Yeah, one other thing I'll just touch on there is that when you look at load flexibility, one of the advantages that you can get is it allows you to offset and delay infrastructure upgrades. So being able to delay a distribution system upgrade, a substation upgrade. So the other need is kind of the modeling and communication ability to be able to assess and communicate what the locational value is of load flexibility resources. So being able to actually monetize and quantify what some of those deferral advantages and benefits are from like a non-wires alternative standpoint. So there's needs there as well.
So the next questions are on ancillary service policies and how they'll change. Basically, how are ISOs in particular going to change their ancillary service requirements, both as we have more renewables coming on the system, and what are the new products and perhaps what's going to happen to some of the old products for ancillary services to address renewable integration?
Yeah, that's another good question. The first thing I'll touch on is that ancillary requirements very much change with renewable penetration. So we've seen, as renewable penetrations have gone up, we've seen ancillary service requirements go up as well. California has gone up quite a bit. ERCOT has a model for kind of how much it'll go up with increased penetration. SPP, same story. The other thing that we're seeing, and it's always the systems with the highest renewable penetrations are kind of the guinea pigs for figuring this out. And so we expect that the other markets will be able to learn from that and just kind of roll it out as needed. But we're seeing in SPP as well as in CAISO, kind of the development of some sort of ramping reserve product. So some of these are in proposal stage. Some of these are looking to be pretty close to final. But a ramping or imbalance reserve where you have an ancillary product that's designed to meet net load ramps rather than just kind of a simple spin product. And again, that's a product that's really well suited for storage as well as for other quick turn on, high ramp rate, flexible resources.
I would just add to that, regulation will increase a little bit, and that's that fast frequency response, kind of something in 4 seconds to maybe, or a minute in one direction, maybe a couple minutes in one direction. And then you start moving into integration with, it's called ink and deck movements of generation. And that's largely addressed by the 5-minute real-time market as well. But there are new market commodities like the flexi ramp product in California and the day-ahead imbalance reserve market as well. So we're seeing some changes there to further incentivize more flexible resources to deal with the integration. And at times of the year, like in California, I'd say more broadly in the West, address the surpluses. And I think we're seeing, the spring, 20% of the energy when the sun was up was being dumped in California. But yet thermal was still running at about 20% of the system load requirements. That might change as we get a lot more storage on the system. And that'll also change how ancillaries are valued and treated. Brent will go over that in the upcoming slides. Listen, the last question is something we can't leave this first Q&A without addressing, Brent. And I know we share a similar, less sanguine view on this. How does Ascend view the potential for a standalone storage ITC? Is this likely to happen? And what do you think it will look like?
Yeah, that's a good question. I think a lot of people want to believe it will happen. What I have seen is that I think 3 times there has been draft legislation with a standalone storage ITC in at the very end, and then it got removed at the last minute every time. So I strongly suspect that there are some vested interests that are making sure that that doesn't get through. There could be a variety of reasons for that. Trying to minimize competition for peaker plants, maybe try to keep storage out of capacity markets potentially. But what I know is that there have been several times where it looked like it was going to happen, and then each time it got pulled out at the last minute. And so my suspicion is that it will not happen. If I had to bet, I would bet against a standalone storage ITC. Certainly could happen, but just based on what's happened in the past, it doesn't seem super likely. And based on the dynamics of how the markets are evolving, storage is doing pretty well without an ITC. So that kind of undermines some of the argument for it in the first place. If it does come through, I would expect it to be kind of aligned to the solar ITC, with a similar phase out, similar levels, similar timing. I think it's very unlikely that a direct pay option comes in. I think if it does come in, it'll continue to be as a tax credit. Direct pay option is just much more difficult logistically from a policy standpoint. So I think the folks that are hoping for a direct pay standalone storage ITC, I think they're going to be very disappointed. But if you'd asked me a year ago, I would have said it was pretty likely. But after it got pulled again in the fall, I think I'm doubtful.
Well, Brent, I think we all here share your view at Ascend, as you know, with fooled once but not twice, so to speak, and a little less sanguine about that. As you go forward in the slides, I know you'll be talking about the MOPR and the impact of that on capacity markets and how that will impact the Eastern U.S. I think that's something that's come up as well. And I think that's it for this portion of Q&A, and look forward to the next round in about an hour.
All right, great. Thanks, Gary.